Okay, here we are with chapter 4. And chapter 4 is really our last review chapter from 3441. So it's all about different entity characteristics. So this chapter talks about legal characteristics as well as non-tax characteristics, and then it talks about tax characteristics as well. And for this class, obviously, we're more concerned with their tax characteristics, but there are a couple of things from an overall entity characteristic that we need to talk about, okay? So I'm not going to read every slide to you because there aren't necessarily places that I want to add things everywhere, okay? So this slide just talks about essentially how they are legally formed, okay? And then liability responsibility is something that that certainly is an important topic, although it's not directly related to taxation, okay? It is important to know that so sole proprietors sole proprietors are not automatically a single member LLC. So if they want to be a single member LLC, they have to organize as such in their state, and then they will be relieved of corporate liabilities. If they are simply organized as a sole proprietorship, then they're absolutely responsible for all the liabilities. So that is an important nuance. Okay, this is a great overview slide because it's a nice little chart, and it talks about kind of who's responsible for what and how they have to formally organize or not formally organize depending on their organization. Okay, so now we start getting into tax classifications, and remember that we have these what are called check the box regulations, and quite literally there's a box on the tax return that determines how you want your entity to be taxed. For a flow-through entity, you can be taxed like a partnership, or you can be taxed like a C corporation, and you check the box that determines that. Remember, there are different return timelines for tax-paying entities versus flow-through entities. Remember that a tax-paying entity, C corporations, trusts, estates are tax-paying entities. Flow-through entities, partnerships, LLCs, S corporations typically. And remember that a flow-through entity means that that particular entity, the LLC for example, doesn't pay entity level tax. Those taxes flow through based on your ownership. And there are some nuances between how partnerships, LLCs, and S corporations work, and that's really the focus of the rest of the course, okay? So unincorporated entities are partnerships, sole proprietorships. And so they're taxed like partnerships if they have more than one owner, okay? And then they're taxed as a sole proprietorship if they're owned by an individual or as a disregarded entity if held by some other entity. So what does that mean? That means if I, Michelle McFessel, go out and start a landscaping business, just by myself, and form an LLC, it's going to be taxed like a sole proprietorship if it's just me. If I join with a friend and together we create an LLC and do landscaping, then we can elect, to be taxed as a C corporation, or we can be taxed like a partnership. Okay, so if you were to have a sole proprietorship with you and a friend, and you chose not to incorporate like an LLC, okay, then you're going to be taxed as a partnership. If a corporation would own an unincorporated entity and they're the only holder of that entity, then it's treated as a disregarded entity. So essentially what that means is the income and expenses of that unincorporated entity are just reflected on, then if it was a corporation that was owning it, on their corporate income tax return. All right, so let's slow down just a little bit here because we've got a couple of things to talk about. So we know that income generated by flow-through entities is taxed to the entity owners. And we know that C corporations pay an entity level tax, and then shareholders pay taxes if you sell stock or if you receive dividends, okay? Because now we're talking about this double taxation that we always talk about with respect to C corporations, okay? Now, C corporations can defer that second level of tax by not distributing earnings, right? But you have to be careful about that, because if they retain, earnings for tax avoidance rather than for a business purpose, there is an accumulated earning tax that can be levied, and again, when we get deeper into corporations, we'll talk more about that. So let's say this. I'm going to move that around a little bit. Okay, but they must be careful about accumulated earnings tax. All right. Now, what else do we need to talk about? Well, we need to talk about dividends just a little bit. Okay, so if you're a corporation and you get dividends, dividends are included in your income, but there is also, remember, a dividends received deduction. Depending on their ownership stake. And remember, the dividend received deduction is 50%, 65%, or 100%. Depending on their ownership percentage. All right, we've got some things to talk about with this slide. So here we've got some really good information, important information about flow-through entities. And it's important that we pause here a minute and talk about self-employment taxes. Okay, so self-employment taxes impact people who are operating flow-through businesses. Okay, because income is taxed at the individual marginal rate, and the top rate is 37%. Passive investors are also potentially subject to a 3.8% net investment income tax. Okay, what does that mean? Well, what that means is that what it might mean is that if you are an owner but not an employee of an LLC, for example, then your flow-through portion might be classified as investment income. Okay, so you have to be careful about what your role is. Okay, if you're involved in the entity's business activities, so you're the one of the partners of the partnership, but you also are doing the work of the partnership, then you're going to be concerned with self-employment tax, or this 0.9% additional Medicare tax. Okay, and there are a couple of things that that we need to talk about, kind of a review from self-employment. So let's talk about self-employment taxes just a minute. So self-employment tax, remember that the tax base is your net earnings from self-employment. Okay, and the net earnings are equal to 92.35% of your self-employment income. Okay. So this slide talks about a little nuance with S corporations. And so if you are a shareholder of an S corporation, not an employee, but a shareholder, then the distributions that you get as entity income, because it's a flow-through entity, are not subject to self-employment tax or the additional Medicare tax. So this is a great tax nuance, if you will, of S corporations. Remember that the Tax Cuts and Jobs Act brought with it this deduction for qualified business income, or the QBID. Okay, and so it's potentially available to flow through entity owners. Remember that it is a from AGI deduction, but it's not an itemized deduction, so you can take the standard deduction and still get a QBI deduction. And the QBI deduction is basically 20% of your qualified business income. And what is your qualified business income? Well, your qualified business income has to meet these three categories, okay? And QBI does not include Income earned as an employee, or guaranteed payments. And remember that partnerships sometimes have guaranteed payments in the partnership agreements, and so guaranteed payments would not be part of QBID calculation. Okay, remember that C corporations now have an entity level tax of 21%, and then there's a second level of tax when for shareholders, right? When you receive a dividend, and those are preferential rates of 0, 15, or 20%, depending on your income level. And you may also, as a shareholder, have this 3.8 net investment income tax, okay? Remember that your net investment income is your gross investment income minus investment expenses. And your net investment tax is 3.8% on the lesser of net investment income or AGI in excess of a threshold amount. Okay, and what is that threshold? Well, for married filing jointly, the threshold is $250,000. And that's for married filing jointly or surviving spouses. For married filing singly, it's $125,000, and then all others, it's $200,000. Okay. All right, this is a great corporate sum up slide, but we've already talked about most of these things roundabout. So remember the dividends received deduction. An interesting thing that we haven't talked about previously, institutional shareholders don't pay shareholder level tax on dividends, okay? And then you also have some carve-outs for tax-exempt and foreign shareholders. All right, so this slide talks about how owner compensation is dealt with by these entities. And by owner compensation, they mean that if I am a part owner of a sole proprietorship or an S corporation or a C corporation or a partnership, but I'm also an employee of that entity, how is my compensation dealt with at the entity level? Okay. From a sole proprietor perspective, you're not deemed to have any compensation as such. Everything that the sole proprietorship earns is flows through directly, and so it's all self-employment income. There's not a difference between entity income and a salary. Okay, for S corporations and C corporations, wages and salaries are subject to FICA. And then they're deductible by the entity, and they're not eligible for the QBI deduction. Okay, and we already talked about that. For partnerships, you have these guaranteed payments, right? And then that would be considered self-employment income, and it's deductible by the entity, right? But it's not, so it's going to reduce the income of the business, but it's not eligible for that qualified business income deduction. All right.